Picture this. It's a regular Tuesday night. You did everything right. You show up to work. You pay the bills. You try not to live too crazy. And every paycheck, you send a little slice of your life into your 401k. Maybe you've got an IRA on the side. Nothing fancy, just a slow, grown-up plan. Then you open your phone. The market is down hard, not a little red, down like the floor fell out. The headlines are screaming. Your group chat is suddenly full of financial experts. Someone says, "This time is different." Someone else says, "I'm going to cash before it goes to zero." And in that moment, your brain doesn't feel like an investor's brain. It feels like a survival brain. Your stomach tightens. You start doing math you never do. You picture retirement like a door that's slowly closing. You can almost feel years of discipline evaporating in a week. Now, here's the uncomfortable truth most people never admit out loud. The next crash won't destroy the average middle-class investor because stocks went down. It'll destroy them because they'll be forced, financially or emotionally, to sell at the worst possible time. That's why, if you're terrified of the next crash, the most important thing you can do has almost nothing to do with predicting the market and everything to do with building a margin of safety that makes panic selling unnecessary. And in a few minutes, I'm going to give you a 2-sentence rule that instantly cuts through the chaos on the scariest days. It's simple, it's not motivational, it's mechanical. And it's exactly the kind of thing Benjamin Graham would have loved because it protects you from the most dangerous investor you'll ever meet, you. Quick note, this is educational, not personal financial advice. The goal is to give you a Graham-style framework so you can make calmer, smarter decisions for your own situation. Now, let's talk about the crash. Most people treat crashes like rare monsters, like something that shows up once in a generation, eats a bunch of portfolios, and disappears. Benjamin Graham saw it differently. He saw market declines as part of the basic climate of investing, like winters. You don't prevent winter. You prepare for it. You dress for it. You build a house that doesn't collapse when the temperature drops. And Graham's entire philosophy, especially for ordinary investors, was never about being fearless. It was about being prepared, because the greatest edge in investing isn't IQ. It isn't secret information. It isn't even picking the perfect stock. It's survival. It's staying solvent, staying calm, staying rational, staying in the game long enough for compounding to do its quiet work. That's what margin of safety really is. Not a spreadsheet trick, not a fancy valuation model. Margin of safety is the space between you and disaster. And if you're truly terrified of the next crash, your first move is not find the next winning investment. Your first move is to build a personal and portfolio structure that makes you nearly impossible to knock out. I want you to think in 3 layers, 3 buffers, like 3 locks on the door. Layer 1 protects your life from the market. Layer 2 protects your portfolio from your emotions. Layer 3 turns crashes from nightmares into opportunity without pretending you can time the bottom. Let's start with the layer almost everyone skips and then regrets, because this is the layer that decides whether you become a forced seller. The first thing to do before the next crash is build what I call a sell nothing fund. Most people call it an emergency fund. And yes, that's what it is. But Graham would want you to understand the real purpose. It's not just to pay for emergency. It's to prevent you from liquidating investments at depressed prices when life hits at the same time as a downturn. Because the most brutal scenario isn't market down 30%. The most brutal scenario is market down 30%, and you lose your income. That combination is how people lock in losses and never recover psychologically. They don't just lose money, they lose confidence. They stop investing for years. They miss the rebound. And the crash becomes a permanent scar. So the question isn't, do you have an emergency fund? The question is, if the market fell hard tomorrow, could you go 6 months without selling a single share of anything? Not because you're tough, but because you're funded. And if your answer is no, that's not a moral failure. That's just the actual problem you need to solve before you worry about anything else. Then comes the second piece of layer 1, high interest debt. In a crash, debt is emotional gasoline. If you're carrying credit card debt at painful rates, it's like you're investing while someone quietly holds your ankle. The market doesn't even have to fall that much to make you feel trapped. Your monthly obligations shrink your freedom. Your freedom shrinks your patience. Your patience shrinks your ability to behave rationally. Graham talked about the investor's need for safety. Debt, especially expensive debt, reduces safety. If you're terrified of the next crash, ask yourself, how much of my monthly paycheck is already promised to the past? Every dollar you owe at a punishing rate is a dollar you can't use for flexibility, for opportunity, for breathing room when fear hits. Third, protect your plan from life stacking. This is the part that sounds boring until it saves you. Check your insurance deductibles. Look at what a real medical issue would cost you out of pocket. Look at what happens if your car gets totaled. Look at what happens if your home has a major repair. I'm not saying this to scare you. I'm saying it because in a downturn, small surprises feel like threats. Threats create urgency. Urgency creates bad decisions. The market doesn't need to bankrupt you. It just needs to pressure you at the wrong moment. Layer 1 is boring on purpose. It's the foundation, because once you have runway, once you have the ability to go months without selling, you've just eliminated the single biggest reason ordinary investors get wiped out. Now we move to layer 2. This is where Graham becomes painfully relevant for modern investors. Layer 2 is portfolio structure, not stock picking, structure. Because the average investor doesn't blow themselves up because they didn't know which company would outperform. They blow themselves up because their portfolio demanded courage they didn't actually have. And there's nothing wrong with that. It's human, but it's expensive. Graham's core distinction was between investing and speculation. Speculation isn't evil. It's just a different activity. The danger is when you speculate while believing you're investing, especially with money your future depends on. If you're building retirement security, if you're a middle-class investor trying to retire with dignity, your portfolio should not require you to be brave. It should require you to be consistent. So here's a Graham-style question that cuts through everything. What allocation can I hold through a bear market without changing my plan? Not what looks best in a backtest, not what did great in the last bull run, not what your coworker says is obvious. What can you hold when the headlines are screaming, your account balance is down, and the world feels unstable? Graham recommended that ordinary defensive investors keep a meaningful portion in high-quality bonds, and he often talked about a range commonly referenced as not less than 25% and not more than 75% in either stocks or bonds, depending on conditions and temperament. The exact numbers aren't the point. The point is, your allocation should match your temperament, because temperament decides behavior, and behavior decides outcomes. Here's the uncomfortable reality. A 100% stock portfolio might be mathematically optimal on paper for some long horizon, but if it causes you to panic sell in a crash, it becomes the worst portfolio you could have owned, because the best portfolio is not the one with the highest potential return. It's the one you can actually stick with. That's why bonds and cash matter more than people want to admit. Not as a return engine, as psychological insurance, as ballast, like weight in the bottom of a ship that keeps you from capsizing in a storm. When the market drops and your stocks are down sharply, the presence of stable assets changes your internal conversation. It gives you option. It reduces desperation. It reduces the feeling that you must act right now. And once desperation disappears, your rational mind comes back online. Now, a quick word about simplicity. In stressful markets, complexity breaks. Complicated strategies that look brilliant in calm markets tend to fall apart when emotions spike. People abandon them. People second guess. People chase the thing that worked yesterday. A Graham-style approach for ordinary investors leans toward simple, diversified, high-quality exposures, broad index funds for equities if you're a defensive investor, or carefully selected quality businesses if you have the skill and discipline for it, and a stabilizing allocation in high-quality bonds or cash equivalents, depending on your plan. And here's the most important mechanical habit in Layer 2, rebalancing. Rebalancing is the quiet hero of disciplined investing, because rebalancing forces you to do what your emotions hate. When stocks fall, your stock allocation shrinks. Rebalancing tells you to buy more stocks to return to your target. That feels terrifying in the moment because it feels like stepping toward the fire. When stocks soar, your stock allocation grows. Rebalancing tells you to trim and move into safety. That feels foolish in the moment because it feels like leaving the party early. But this is exactly what intelligent investing looks like in practice. You systematically buy what's become cheap relative to your plan, and you systematically reduce what's become expensive relative to your plan. Not because you predicted anything, because you're refusing to let Mr. Market bully you into emotional timing. And that leads us to the character Benjamin Graham gave the market, one of the most useful mental models ever, written for ordinary investors. Mr. Market is your business partner who shows up every day and offers you a price. Some days, he's euphoric. He offers ridiculous prices because he's sure the future is perfect. Other days, he's depressed. He offers insultingly low prices because he's sure the future is hopeless. Graham's genius was telling you that you don't have to agree with him. You don't have to argue with him. You can ignore him, or you can take advantage of him, but only if you prepared your finances and your portfolio so his mood swings don't force you into a decision. Now we're ready for Layer 3, the crash playbook. This is the part people think they want first. What should I do when the crash hits? But now you see why it comes third. Because without layers 1 and 2, Layer 3 doesn't matter. You'll still panic sell. You'll still get forced out. You'll still react. Layer 3 is how you behave when prices get irrational, when the sale signs go up, and the first move in Layer 3 happens before the crash even arrives. You build a shopping list, not a watch list of hype, not a list of stocks that went up a lot, a shopping list of things you'd be happy to own if Mr. Market offered them at a meaningful discount. If you're a defensive investor, that list might be very simple. Broad, low-cost index funds and a plan to rebalance into them as they fall within your target allocation. If you're more enterprising, if you actually want to pick individual stocks, then Graham's principles become even more important. You demand a margin of safety. You focus on financial strength. You focus on a real business with real earnings power. You avoid story stocks that require perfect futures. But regardless of whether you buy funds or individual businesses, the psychological weapon is the same. You decide in advance what you will do, because the crash is not the time to figure it out. The crash is the time to execute the plan you already wrote while you were calm. So here's a Graham-style crash plan that ordinary investors can actually follow without pretending they can time the bottom. You pre-commit to actions at certain levels of decline, and you keep it consistent with your allocation. For example, you might decide something. If the market is down around 20% from its highs, I will rebalance back to my target allocation. If it falls further, I will continue rebalancing at set interval or increase my contributions or deploy a portion of my cash buffer without exceeding my risk limits. The exact triggers are less important than the principle. You're creating a rule-based system so you don't make decisions purely from fear. And notice what we're not doing. We're not saying, I'll buy the bottom. We're not saying, I'll get out before it falls. We're not saying, I can predict when it will end. Graham would call that speculation dressed up as confidence. Instead, we're doing something much more powerful. We're admitting uncertainty and designing behavior that works anyway. This is where dollar-cost averaging becomes emotionally valuable. A lot of people argue endlessly about lump sum versus DCA, but that argument misses the real issue for terrified investors. The real issue is, what plan keeps you consistent? If you have a large sum and investing it all at once will make you lose sleep and potentially panic sell, then a paced approach can be a behavioral margin of safety, not because it maximizes returns in every scenario, because it maximizes your odds of sticking with the plan. And sticking with the plan is what makes compounding possible. Now let's talk about what not to do, because crashes create temptation. In crashes, people crave certainty. They want a single move that guarantees safety. That's when the bad ideas get loud. Leverage becomes seductive. If I just borrow a little, I can make back losses faster. Concentration becomes seductive. If I just go all in on the best idea, I'll recover. And then the worst one, I'll sell now and buy back later when it's safer. That last one is the trap that ruins decades because it sounds responsible. It feels responsible. You're protecting what's left. But what usually happens? You sell when fear is high. Then you wait for clarity. And the market, because it's cruel, often rebounds while clarity is still missing. Then you hesitate. You feel stupid. You demand a lower price. And suddenly, you're out of the market during the recovery, the exact time when long-term returns are often made. Graham's style of protection is not frantic activity. It's rules. It's valuation discipline. It's balance. It's refusing to act under emotional coercion, which brings us back to the open loop I promised, the two-sentence rule. This is the rule that stops panic selling. Write it down. Put it somewhere you'll see it when the headlines hit. Here it is. I do not sell sound investment because prices fell. I sell only when the underlying business or my long-term plan has changed. That's it. 2 sentences. And you might be thinking, okay, but how do I know if the business changed or if it's just fear? Good. That's why you need one more tool. One document that sounds boring but functions like a seatbelt, a simple investor policy statement. Don't overcomplicate it. Graham wouldn't want you to. Your investor policy statement can be 1 page. It should answer 5 questions. What do I own? Why do I own it? What is my target allocation? When will I rebalance? Under what specific conditions would I sell? And here's the key. Your sell conditions should be fundamental and structural, not emotional and headline-based. If you own a broad index fund as your equity core, your sell conditions might be almost non-existent because the point is to own the productive engine of American business over time through cycles and rebalance. If you own individual business, your sell conditions might include things like the balance sheet deteriorates dramatically, the economics of the business permanently change, management destroys shareholder value, or the stock price becomes wildly above your estimate of intrinsic value and you have better opportunity. Not the market is scary, not a pundit said we're doomed, not my neighbor sold. And one more rule that sounds simple but is unbelievably powerful. No major portfolio decisions on headline days. If you feel the urge to do something right now because you're flooded with adrenaline, that is not an investing signal. That is your nervous system asking for relief. Delay is a weapon. Even 24 hours can bring your rational brain back. Now, let's bring this full circle. Go back to that Tuesday night. The market is down hard. Your account balance is lower than it was last month. The news makes it sound like the world is ending. In the old version of this story, you stare at the screen, heart pounding, and you ask, should I sell? In the new version of this story, your version, you don't ask that question first. You ask a different question. Am I forced to sell? And because you built layer one, the answer is no. You have runway. You have a sell-nothing fund. You reduced expensive debt. You checked the weak points where life could stack on top of a market decline. Then you look at layer two. You remember your target allocation. You remember your portfolio was built so it doesn't demand heroism. You remember your bonds and cash are not there to impress anyone at a cocktail party. They're there to keep you rational. And then you look at layer three. You don't scroll for predictions. You don't ask strangers what happens next. You open your plan. You rebalance if it's time. You continue contributions if you're able. You execute the rules you wrote when you were calm. And suddenly, the crash changes shape. It's still unpleasant. It's still emotionally heavy, but it's no longer a personal apocalypse. It becomes what Graham always knew it was. Mr. Market in a bad mood, offering you better prices. Not because he cares about your retirement, not because he's fair, but because he's irrational. And that irrationality, when you're prepared, is not a threat. It's an advantage. This is what getting rich slowly actually means. It means you stop trying to win the next 6 months. You stop trying to look smart every week. You stop treating investing like entertainment, and you start treating it like building a bridge, overbuilt, redundant, boring, strong. So when the storm comes, and it will eventually, you're not standing there with hope, and you're standing there with structure. And that's the final message Benjamin Graham tried to hand to ordinary investors. You don't need to predict crashes. You need to be the kind of investor who can live through them, because the next crash is not the moment you discover who you are. It's the moment your preparation shows. And if you do this first, if you build your margin of safety in your life, your allocation, and your rules, then the next crash won't be the thing that steals your future. It'll be the moment you realize you were finally investing like an intelligent investor, calm enough to ignore the shouting, prepared enough to avoid forced selling, and disciplined enough to let time do what time always does. Reward the patient.